in the back here.
No.
Hiya, everybody.
Hi,
Hello,
Doctor.
Anna.
Yeah, hi. Sorry, hi.
How are you?
Yeah, yeah. I think we should just let everybody know that the session has started. What is that session again?
Yeah, I'm thinking probably if people up to like 5 minutes. Yes, please, Prof. You can hear me? Yes.
Okay, I found it.
What did you say there?
No, I found it. I was looking for the tax one on the group. Let me send it. Hi, everyone.
Hi, Mr. That was saying.
Session.
Hello.
Oh, hi. I'm just going to, my name is JJ. I'm just going to, and I'll be kind of heading the meeting, kind of. I'm just going to probably wait for another 3, 4, 5 minutes for people to join. And then we will be able to.
Hello, Remi. Hi.
Hi.
This is Dr. Jaja, and that's Professor Jegzi. Dr.
Prof.
Jaja. Dr. Jaja is the group leader of one of the
Hi.
founders group in the community. Professor is one of our group leaders in the community as well. And ladies and gentlemen, this is Mr. Remi Oseni. I like to harass the guy anytime I see it. And
Yes.
It's good you are confessing your sins.
And he's just tired of me, but he just can't get rid of me, unfortunately. Yeah, so Remi, are you safe hands? I'm just going to be here listening because I want to also learn this session.
Excellent. Excellent. Happy to be here.
Thank you so much for coming.
Thank you so much for coming.
Yeah, thank you for having me. So what's the process? Are we ready to kick off or are we waiting for others?
Yeah, I just wanted us to wait till like 6:05.
Okay.
5 minutes after, and then I can start with the intro and then we can start. We can kick off.
Okay.
Just trying to give people more time to join. Sandra, could you please mute yourself, please? Okay, I think we probably would start so that we don't keep the time and then we can. Sorry, I was just trying to look at some of the messages that I was receiving. Anu?
Yeah,
Anu,
yes, hi.
what do you think? I'm thinking, should we just start and then ask
Yeah. Please go
so
ahead.
that we can move on.
I mean, since Remi, I hope it's okay that we're recording this and we'll just record and upload. It's on
You're
site.
muted.
You're
You're
muted.
muted.
Yes, it's fine. Yes.
Yes.
Okay.
Since it's going to be recorded, it can go up on YouTube. And
that's what I felt. Okay. Like I said in the beginning, my name is JJ. I'm one of the leaders of one of the finance group. And thank you again for honoring our invitation to this meeting today. And by way of introduction, I will just tell everybody that this is Mr. Remi Oseni. He is a chartered accountant with over 10 years accountancy practice in the UK. He's a fellow of the ACCA and IFA with a postgraduate degree in business analysis and finance from the University of Leicester with 19 years experience in financial services and management services. He has supported financial institutions including NatWest, Lloyds Banking Group, and Aberdeen Standard Investments on regulatory integration and divestment programs at group finance level. More recently, pioneered 2 startups in fintech and accounting/tax services in the UK. So he's very much into tax processes in the UK, and he's going to be speaking with us for this session. Mr. Oseni, typically we allow you to do things the way you want to do it. So sometimes we start off with, if you would like to make a presentation for about 30-45 minutes, depending on you, and then we take questions afterwards. Or if you just want it to be like a question answer session where people ask you questions and then you answer, or it's going to be like a discussion, it is left to you to do your thing. We kind of like to keep to time, being that 1 hour, we plan to have the meeting for just an hour. And so whichever way you prefer, I think that I'm okay for us to start after the opening prayer. So let's see. Sandra, could you just give us a short opening prayer? If she's there. Sandra?
Yeah, I really can't. My daughter is a bit unsettled, please.
Oh, okay. Can Anu, you want
sorry.
to just give us a short prayer?
Yeah, sure. Why not? Our Father and our Lord, we thank you for the time together this evening. Thank you for the grace for us to gather. We thank you for your son, Remi, who is going to speak to us. We ask him for wisdom, intelligence, and for us that are listening, understanding that we might apply to whatever situation we find ourselves. In Jesus' name. Amen.
Thank you. The floor is open.
Okay. A very big thank you to you all for inviting me to this session. I'm happy to be here, and hopefully I'm able to provide you with information you can take away and make use of. So in terms of what I'll cover and what the approach would be, I have a set of slides that kind of looks at the various tax categories and who should, or what aspect of those tax categories applies to different circumstances. So I'll just put that up so that everyone can see. Do you mind enabling sharing for me, please?
Jeje, you're on mute.
Thanks. I've made you a co-host, so you should be able to share. Yes.
Yes. So thanks very much. So I mean, it's just a simple slide that looks at the broad tax categories and, you know, those categories impact. The categories I've put here, I mean, there could be more categories, but these are the ones that, you know, come to my mind. So you've got employees, you've got contractors. Contractors could be a director of a limited company, or could be a fully fledged entrepreneur that's running a small business or a big business. You have a contractor that is self-employed, you have an investor, then you have people that have a side hustle. And for each category, I've tried to kind of demonstrate, you know, what types of tax each category of an income earner should consider. So for an employee, of course, you'd consider your pay-as-you-earn tax. Potentially, you'd consider inheritance tax at some point. And you would consider capital gains tax if you were involved in any form of investments on the side. As a contractor, if you're working as a contractor through your limited company or as an entrepreneur, you would consider PAYE, pay as you earn, if you had a payroll running for your company. You would consider dividend tax because essentially, if your company makes profits, part of the ways you get paid is dividends from your company. You would consider inheritance tax as well at some point, and capital gains tax as well if you're involved in investments or you decide to sell your company. If you're also a contractor, but you're a contractor as a self-employed individual, you would consider income tax, inheritance tax, or capital gains tax, depending on the kind of stuff you're doing. And if you are an investor, you would consider capital gains tax, property income tax if you're doing property, and dividend tax if you're doing stocks and shares. And of course, if you're any of those above categories and you have a side hustle going along on the side, you'd consider personal income tax or capital gains tax, depending on what you're doing. So those are the broad categories of taxes and how it applies to different categories of people and incomes that they earn. In terms of the audience, I'm guessing there are people that fall into either one or several of these categories. And this slide is just kind of like an introduction so that it kind of gets your mind thinking about, okay, what potential tax category applies to me? And it kind of helps to trigger any questions you may have in your mind. In terms of how the or the conversation would go, I would prefer it to be kind of an open questions and answer session where you can kind of feel free to throw questions at me from any angle, and I'll be happy to deal with them. Speaking to Anu previously, she'd mentioned that there had been questions on the forum that people had in their minds and they wanted clarified. So I'm hoping you have, those questions ready to go, and I'm happy to answer them. In terms of taxes, the reason why I've taken this approach is tax is a very, very wide area to deal with. And if I was to focus on any one area specifically in terms of a presentation slide, it could easily take the whole hour. So for example, pay as you earn on its own would take an hour to kind of talk through. So I think it's probably better guided by specific questions that people have, and then I can deal with them and then kind of add more flavor to it as we go. So I'll probably just pause there and just kind of take a pulse check to see if anyone has any questions.
Remi, can I go first, please? Because I have questions. Remi, please, how do I reduce my tax obligations? Now, I know that the more you earn, the more your tax percentage increases. So as an employee, I have to pay tax as an employee. Then I'm doing side also, I have to pay tax out there as well. My question, and it just feels to me like every money you pay almost 40% to the government in one form or the other. So straight up, my question is, what are those legal tax opportunities that I need to take that I don't have to pay tax? That, well, no, I'm sure I have to pay, but that is significantly reduced. That's my most important question.
So yeah, to deal with your question, I mean, you kind of hit the right buttons there. You can't avoid tax altogether, except you're willing to do something that is not quite legal. However, you can mitigate taxes, and there is no one size fits all way to say, this is how I would reduce my tax. Because if you look at the categories I've illustrated there are different categories of taxes. And for each category of tax, there's a different tax rule, which means you have to plan differently for a particular tax category that applies to you. So for example, if it's inheritance tax, you have to kind of structure yourself in such a way that the impact is minimal by doing certain things. If it's capital gains tax, you have to position yourself in a particular way by doing certain things to mitigate the impact of the tax. So it's not usually a one size fits all, but I'll give you examples. Okay, so let's take inheritance tax as an example. You are approaching the late stages of life and you feel, okay, I've built up a sizable amount of assets, and on passing on, which is inevitable, I want to mitigate the impact of inheritance tax on the people that I pass on the assets to. So you begin to think, what do I do now? How do I plan now to mitigate that impact? One of the ways of doing that is understanding the rules around inheritance tax. One of the rules, for example, is saying, okay, if I begin to give my assets away early, then there's a chance that my inheritors don't pay inheritance tax. So for example, there's a rule around the 7-year rule that says, if I give away an asset, provided I live longer than 7 years after I've given it away, then the beneficiary doesn't pay, or it is not included in my estate for inheritance tax calculation purposes. So that is an example of a way to mitigate. So you're kind of almost forward planning to say, okay, this is what I'm going to do based on my understanding of how inheritance tax works to mitigate the taxes. For things like pay as you earn, for example, those are taxes that are deducted at source by your employer. For that kind of a tax, there's little or nothing you can do to mitigate those taxes. There are a few things you can do to claw back some tax reliefs, but by virtue of the fact that they're taken at source, you can't kind of proactively mitigate it. You can claim a relief afterwards, but the tax is taken at the point you're being paid. There's nothing you can do about that. There's certain rules around, for example, you could claim release for certain expenses that are related to your work. And a lot of people are kind of doing that lately. But again, it's something to be careful about when you do it. So HMRC or the tax rules allow for you to be able to claim release for expenses you incur in the course of doing your work that has not been catered for by your employer. So say, for example, you are doing work as an employee, but you've had to provide your own laptop to do the work, and that laptop has not been provided by your employer. You could claim a tax relief for that at the end of the tax year by making a tax relief claim to HMRC. But what you then find is naturally a lot of employers provide you with a laptop anyway. So in most cases, you tend not to be able to take advantage of those tax reliefs. There's also certain tax reliefs for instances where you're working as an employee and you've been asked to go and work in a temporary work location. And therefore, you're having to pay the cost of you going to that temporary work location to do that work. If your employer doesn't pay that cost, then you can claim a tax relief. So there are certain specific circumstances under which you can claim those kind of tax reliefs. So I'm explaining that just to kind of demonstrate that you can mitigate taxes, but it's usually not a one-size-fits-all. You almost have to look at the specific circumstances of a specific individual to be able to then recommend and say, given this scenario, given this set of circumstances, these are the steps you can take to either claim a relief or mitigate the impact of tax. Does that make sense? I know it doesn't really answer your question.
Okay, let me bring it home as it's paining me in my body.
Okay.
Side also personal income tax. How do I reduce my tax obligations? Contractor, how do I reduce my tax obligations? Employee, there's really nothing I can do about it. But the contractor part and then the side also is as it relates to me. So how do I reduce my obligation? What are those things that I can do proactively and also gain? What's the word you use now? Like get it back or what? Sorry, there was something.
Relief.
Relief, yeah, thank you.
And so let's take it one at a time. So contractor. For a contractor, if you're operating as a director of a limited company, the most tax efficient way to function is to structure your income or your drawings from the profits of the company as a mix of salary and dividends, rather than anything else. As a contractor, using a limited company structure is that route is normally taken because it makes you more tax efficient than if you were to work under the PAYE banner. Because as a contractor, you could as well work under the PA banner, not be a limited company. But the limited company in itself is a structure that allows you to be more tax efficient. And the reason is that when your contract income comes through, okay, it is not taxed at source like PAYE. It comes into a company. And therefore, as a company director, you now have the flexibility of how you draw the money and what you do with the money. So for example, if you were to earn a contract income of £100, that £100 comes into the company and then you're allowed to deduct certain business running expenses before company tax is applied. That process alone makes you more tax efficient than a standard employee, because an employee would not be allowed to deduct those expenses before tax is applied. So that structure in itself is a tax efficient structure. Now, one, the fact that you can deduct expenses. Two, the fact that you can defer or manage the timings of your drawings. So for example, if you're paid £100,000 as an employee in a single year, the whole of £100 will get taxed at source, irrespective of whether or not you're going to use the whole of the £100,000 or not, okay, for your personal expenses or personal living. But as a contractor, the £100,000, the same £100,000 comes in, you deduct your expenses before applying company tax, and then you can decide and say, you know what, I don't need to draw the residual after company tax fully in a single tax year. And therefore, I would only draw the amount that I need for this tax year, which means that I can manage not to be forced into the higher tax band like an employee who will be forced into another tax band immediately the income comes through. as a company director, you can say, okay, this year I'm only needing to draw 30,000 pounds in dividends. And therefore, on that basis, I'm only going to pay a 7.5% dividend tax rate. And then I can defer any residual balance of drawings to the next tax year and still draw the same 30,000 pounds. That's the amount I need, and keep paying the 7.5% tax rate treaty. However, an employee in the same scenario would pay 40% tax in perpetuity. So that's a significant difference already because of that limited company structure. 7.5 versus 40%. So the structure in itself provides you with that benefit of that tax advantage. Making use of that tax advantage is being cautious and being proactive about how and when you draw your income from the company. For example, you could say, okay, I need 70,000 pounds right now as a company director. But if I was to draw everything in a single tax year, that means I will pay 32.5% dividend tax. But as a company director, you have the flexibility of saying, okay, I will draw, if I need 70,000, I will draw 35,000 pounds on the 5th of April of a particular year and draw the remaining 35,000 pounds on the 6th of April that same year, which is you're drawing the 70,000 pounds, but within the difference of a day that falls between 2 tax years. And therefore, you maintain your 7.5% dividend tax rate. Those are the kind of flexibilities that helps you to manage your tax position as a company director. If you're an employee, once your money is paid on the 5th of April, the whole 70,000 pounds gets taxed at 40%. You wouldn't have flexibility of splitting it into 2 or across 2 tax years. Those kind of flexibilities that would help you to manage your tax positions.
Can I quickly interrupt, please? So some people are dropping their questions in the chat box, and some people are raising their hands. So I was just thinking, if you're raising your hand, I would say that once Remi is done with an explanation, you can go ahead and ask your questions. And then for those that are dropping their questions in the chat box, probably when he's done explaining to people, I could read out some of those questions for him to answer, if that's fine.
Yeah, that's fine. Or maybe I should just quickly take the questions on the chat box that we have so far.
Okay, so as somebody said, if I am an investor in holiday-let properties, can I claim capital allowances? One, and how can I claim capital allowances and use that to reduce my business tax?
Okay, so capital allowances essentially are, for the benefit of people that don't know the technical terms, it's like an allowance you get to reduce your taxes for the purposes of buying an asset to do a business or for the purpose of investment. So it's like if you're running a business and you spend money to keep that business running, then for tax purposes, you're allowed to deduct the cost of running the business from the business profits before the residual profit is taxed. It's the same concept for capital allowance. If you are a holiday-let investor and in properties, and you then buy things that are classified as assets, okay, the government has, or the tax rules allow you to claim the cost of those assets before, from the income that's generated before tax is applied on the residual profits. Now, the rate of claims would vary depending on the asset type or asset class. And different asset types or asset classes have different capital allowance claim rates. So that's kind of capital allowance in a nutshell. Now, For holiday lets, and to explain this, I would kind of differentiate holiday let properties to standard kind of residential buy-to-lets. Okay, because I think that's probably the best way to demonstrate the difference. Now, if I have a normal residential buy-to-let, so I buy a property and I let it to a family that lives there for however long they want. Now, if I buy assets into that property to make it into a state that allows me to be able to rent it. So maybe things like a fridge would be considered an asset. An asset is something that has a lifespan that is extended, a useful life that is extended. I buy a fridge, or I buy a set of sofas or a dining table. On a residential buy-to-let, you cannot claim the cost of those assets to reduce your taxes, except you are replacing an existing one. Okay, but for a holiday let property, you can actually claim the cost of those assets. Now, when you're claiming the cost of these assets, the way to do that is you would calculate how much rental income have I generated from this property during this period? How many assets have I had to acquire to get my property in a lettable state? And what is the cost of those? And then you could say, okay, I've gained rental income of £100, but in order to do that, I've had to acquire a sofa to make the house rentable. And the cost of the sofa is, say, £50. Now, what then happens is, normally I will be able to say I've earned £100, I'm deducting £50 for the sofa, and therefore I have a residual on which tax applies. So in this case, the residual profit is £50. Now, what to watch is different types of assets would have different capital allowance claim rates. Some assets could be 25%, some assets could be 100%, some assets could be 75%, depending on the kind of asset. So say, for example, a sofa has a 25% capital allowance claim rate, just as an example. I'm not saying that's exactly the rate. I don't know the specific rates off the top of my head. Then what that means is the sofa costs you £50. My capital allowance rate is 25%. So that means I'll be able to claim 25% of the cost of the sofa in capital allowance relief in that tax year. So I will have income of 100. I will deduct 25% of 50, which is 12.5. And therefore my residual profit is 76.5, which will then get taxed from a tax perspective. Tax is applied on the residual profit. That is how capital allowance works. Now, one thing to watch is to understand, what the type of assets you have and what type of capital allowance rates applies to them, and that kind of guides you into knowing what to claim or claim as capital allowance reliefs as part of your tax returns when you're doing your tax calculations.
Okay.
Hopefully that answers the question on capital allowances.
Is that okay, Adedayo? You asked a question. She asked, there's still another one, still from the same person. Can I place my car into my business? Will it be efficient in a limited company or a limited partnership?
So that is a tricky question. It depends a lot on the type of car it is. Now, different. Okay, let me take a step back. Now, a car by default, okay, is seen as a taxable benefit. Okay, so once you have a car, from a tax perspective, it is taxable. If you have a car and you put it, or if your company buys a car and you use the car either for business or for personal reasons, a car is deemed as a taxable benefit. If it is not a car but a van, then it is not deemed as a taxable benefit, because in the eyes of the taxman, a van is for business, a car is for personal. So irrespective of whether you buy a car and then you use it for business, it is still seen as a taxable benefit. So tax would apply. If you want a vehicle that tax will not automatically apply, then you get a van instead, or a truck. Okay? So now that is the underlying premise. Now, there are two ways in dealing with cars when it comes to business. You can buy the car in the company's name, so the car belongs to the company, and then you can then use the car for either business or a mix of business and personal. Okay? Now, when the car is bought in the company's name, the lease cost is charged to the company. The fuel cost is charged to the company as well. So what that means is the cost of running the car belongs to the company, and therefore it can help you reduce your company taxes. However, on the flip side, you as a business owner is taxed on a benefit in kind basis for that car. So that means that when the company is running its payroll, it would value the car and determine the amount of benefits that accrues to you for having that car. That benefit amount that is calculated becomes taxable as a benefit in kind. So you as a company owner then pays a tax for having that car, having the use of that car. So on one side, you could be saving company tax, but on the other flip side, you're going to be paying benefits in kind tax. So the question is, are you better off saving companies tax and then paying benefits in kind tax? Or are you better off just owning the car outright in your personal name, which is the second approach, and then recharging the business miles to the business? Generally, I think the second approach is simpler and more cost effective than having the car. Because benefits in kind, the tax rate is the PAY tax rate. So that means, for example, for any reason you are a higher tax rate, then you're going to be paying benefits in kind tax, higher tax rate for the use of the car. Alternatively, you could buy the car in your personal name, and then whenever you travel for business, you calculate the business miles traveled and you charge that to the business. And for business miles, you can claim 45p for the first 10,000 miles and 25p per mile thereafter. So 45p per mile for the first 10,000 miles and 25p per mile thereafter. The only instance where it is actually usually really beneficial to have the car in the company name, and where you almost literally avoid benefit in kind tax altogether. You don't avoid it completely, but you almost avoid it completely. You only pay very, very minute amounts of benefit in kind tax is if you were to buy an electric car, because the benefit in kind tax is linked to the car's emissions, car CO2 emissions. So for an electric car, there is zero emissions, and therefore the benefit in kind tax is almost zero. So if your options is to go for an electric car, then it would make sense to buy the car in the company name from a tax perspective. But if you're looking to buy, say, a Mercedes G-Wagon that is a CO2 destroyer, or you're looking to buy any of these big Range Rovers and all that, there's literally no point. Benefit in kind tax is just going to kill you. So hopefully that answers your question.
Somebody else had asked earlier, I guess that's when you were talking about the employee tax, I think. This person said, would that apply for those of us working from home for using my own electricity and internet? So probably when.
Yes, so for people working from home, there's this kind of new tax regime that allows you to claim £6 per week for use of home expenses. That comes to about, I think, £316 a year. So that is something you can claim as an expense at the end of the tax year to HMRC to get a tax relief or a tax refund. If you claim the £6 per week, they're not going to be any questions asked. They're not going to ask you for proof of anything. It's a standard rate claim, and you get a relief for that. So effectively, what that means is at the end of the tax year, if you are a higher rate taxpayer, and you're claiming your £316, so that means you would get a tax relief of effectively 0.4 times 316. This is effectively £126 tax relief at the end of the tax year. That is available to everybody, whoever wants to claim it.
Sorry, Remi, just to be clear, so whether contractor, employee, whatever, as long as you are working from home, you can claim that tax relief.
Yes, you can claim that tax.
As
long as you are required to work from home and you've not chosen to work from home. So there's a difference there. You're required to work from home. But of course, most people are required to work from home during this period. So by default, you should be able to claim it.
Thank you.
Okay. Probably, I think there's another question, but Muji has been raising her hand of a while. So I think probably Muji should ask a question and then we can go back to the chat.
Right. Thank you for the presentation so far. So I happen to be a doctor. I have a full-time job working as an employee, but I also do kind of like locums on the side. I noticed I kept getting these emails from HMRC saying my tax code had changed. And I really don't know I don't know what it means. I don't know, are they deducting a bit more? What does it mean for me and how do you feel I should approach that situation?
Well, so if there can be 1,000,001 reasons why your tax code has changed. Now, when you get a letter from HMRC saying your tax code has changed, they usually would explain the reason why and the basis of the new tax code calculations. Now, from what you've explained, if you've taken on an additional job, that is a singular reason why your tax code could change. Because what HMRC tends to do is they may split your personal allowance across the two jobs, or structure your tax code in such a way that they are able to take all the taxes at source that they need to take based on your projected annual income through your tax code deductions. So say, for example, I'm trying to see an easy way of explaining this. Okay, so say, for example, you are earning £50,000 a year. At £50,000 a year, you would be entitled to your £12,570 tax-free personal allowance. Okay, And tax, when you're taxed through the payroll, it is cumulative. So if at the start of the tax year, your annual salary is £50,000, okay, that means that your monthly salary would be £50,000 divided by 12. Okay, so that is 4,166. So the first month, your employer runs your payroll, your gross income is showing to HMRC as 4,166. Okay, so from that number, HMRC projects what tax you're going to pay for the year, assuming that you're going to earn 4,166 consistently for the 12 months. So it will start to deduct the taxes at source based on 4,166 per month. Okay. Now, so that means your tax will be fixed. However, let's say in month 4, okay, you now get another side job, a locum job, that an additional, say, £20,000 for the rest of the tax year. Okay, but the rest of the tax year is now, say, 9 months. Okay, so HMRC would now say, okay, this person's income has now, annual income has now moved from 50 to 70 because of the additional job. And therefore, the tax rate that would apply is no longer the basic tax rate, is now the higher tax rate, because this person is now a higher tax earner. But now I've been projecting the tax at 20% from the start of the tax year. But now I need to take into consideration this new income and adjust the tax deductions so that by month 12, I would have taken the right amount of tax from the annual income. The way to adjust the tax clause at source will be to adjust the tax code. Sometimes it might be usually to reduce the tax code. So reducing the tax code means reducing your tax allowance, which allows more taxes to be clawed because you're not earning more. And then that is a way of adjusting the tax clause at source such that by the end of the tax year, the tax that should have been taken at source is accurate based on the year-end annual income number. However, I wouldn't worry too much about tax code changes because HMRC also have a self-correcting process to deal with those kind of things. So say, for example, your tax code was adjusted incorrectly for some reason. And at the end of the tax year, it turns out that more taxes have been deducted that should have been. HMRC have a process of sending you a tax refund in the post or adjusting your tax code for the next year such that you now get a tax rebate in the next tax year. So you get less taxes deducted at source in the next tax year, or you get a check in the post. Sometimes, however, it could take quite a bit of time before HMRC goes through that process. And if for any reason you felt, okay, you've paid too much taxes, you could always get like an accountant to look at the numbers for you to assess whether too much tax has been paid. And it could just be the process of requesting a tax refund through your online tax account, and that can easily be resolved. Hope that helps.
Yes, very helpful. Thank you.
Okay.
There's a question around increasing pensions to reduce taxes. Yes, that's an option. Pensions are ways of helping you to reduce your taxes because pensions are allowable expenses that help to reduce your taxes at source. So if you increase your pension contributions, the taxes you pay will be less, generally.
Yeah. Somebody else raising up his hand. Remi, you want to go ahead and ask your question?
All right, thank you very much. Can you hear me?
Yeah, you're a bit faint, but go ahead.
Just a second. Okay, so thank you.
Can you hear him?
Can you hear me now?
Yeah, I can hear you. Go ahead.
All right. Okay. So thank you for that. I have a question. Is like two in one actually. I'm looking at the slide you've put up. I just want to clarify. Um, this contractor self-employed you've put in here, is it the same thing as a sole trader? That's the first question. And then the second question is for a professional who is more or less going to be a one-man service. You're offering a service. So which means if you have a limited company, you're the only director, you're the only employee, so to say. What would you say is better? Is it better to work via limited company, or is it better to work as a sole trader? So that's my question. Thank you.
Okay, thanks, Fab. Thanks. So yes, the self-employed on the slide there is a sole trader. So you're correct there. And working as a professional, in my experience, it's better to work as a limited company rather than as a sole trader. Because as a sole trader, there's certain taxes that you would pay and certain limitations that apply that is similar to being an employee that you avoid if you work as a limited company. So for example, as a sole trader, you have things like class 2 and class 4 national insurance that you pay that you would potentially avoid altogether if you are a limited company. And then also as a sole trader, your profits is taxed within a single year in the same way an employee's income is taxed at source. So you don't have the flexibility of moving, flexibility around tax being applied on your drawings. So if you think about the example I gave earlier, where you wanted to draw 70K from your company, and then you draw 35K on the 5th of April and then 35K on the 6th of April, it breaks it into 2 tax years, and therefore you remain within the lower tax band. If you were a sole trader, if you have that 70% profit on the 5th of April, the whole 70% profit is accessible to tax. So it's more tilted towards an employee PAY situation. So I would usually recommend that a company structure is better.
Thank you so much. Answers my question.
Remi, there's another question on the group that says, as a small business, how far back can I claim my tax? How far back can I claim my tax back? For example, if I buy some assets for the business and I was not aware that I could claim the tax back, how long do I have to make the claims? Is it only in the current financial year, or can it be backdated?
So it depends on this. Well, it depends a lot on the structure of the business. So as a general rule, you're usually allowed to claim taxes going back 4 years. That's a general HMRC rule. And it also applies to if you're doing, say, tax returns and stuff like that. You're claiming reliefs, you're allowed to generally go back 4 years. If you were running a business and you're running it as a limited company and you have assets that you'd not claimed for from 4 years back, then potentially you might need to restate your accounts. And restate your accounts, include those expenses, and resubmit the tax returns. So you can then have your revised tax amount. And if you've already paid the taxes based on the old numbers.
So my wife, I said, who does that? And I'm like, no.
If you've already paid taxes on the old amounts, then the revised numbers or the tax reductions from the revisions could be applied towards any future profits, provided those revised accounts are accepted by HMRC. Hope that answers your question.
Yes, the person said thank you. There's another question. Can I make tax claims for offerings paid to church or other donations? Are there any limits to this?
I would add a bit of context to that. Yes, you can make tax claims on offerings and donations, provided those offerings and donations are made to UK registered charities. So the thing to watch is that the charities are recognized and registered within the UK as part of the UK Charity Commission. Then you'll be able to make tax reclaims for those offerings or donations you make. If you are a limited company director or you run your own business, it's usually more tax beneficial to make the tax donations directly from your business for you as an individual. It's more tax efficient that way. But if you're just an individual, then yes, you don't have any option but you can just claim your tax relief once you've made the donations at the end of the tax year. The way you can do that is by filing a self-assessment or a tax return, and you can claim your tax relief on those donations.
So sorry, Remi, if you could take your one back on this question for donations to charity or registered charities, right?
Yes.
Are you saying that it's more tax effective if I pay through my limited company than if I do it on a personal note?
That's right, yes.
Okay, I didn't know that. Thank you.
Yeah, because the logic behind it is this. If you pay the donation through your business, it's an allowable business expense, so it saves you company tax. Okay, but if you're a company director, if you pay the donation personally, you'd have lost the advantage of saving the corporation tax. So you've paid corporation tax on that, and then you've now done money as dividend. So you paid dividend tax on top of the corporation tax. And then you now give the donation and then you claim back the tax you've paid, the personal tax you've paid. That means you've lost the company tax you could have saved altogether if you're paid directly to the company.
But it must be a registered charity.
Yes. Yes.
How can I check? Is there a way
you can easily check on the Charity Commission's website.
Right. Okay. Cool. Thank you.
The charity name, it should come up if they're registered. Or if you can get a hold of their charity registration number, you plug it in, you see them.
So thanks.
And there's a question around, does this apply to the US? I must say I'm not expert in US tax law or tax rules, so I wouldn't be in a position to confirm that, unfortunately.
Can I say something to that? Tochi, there's a session for US North American tax in 1 hour. This is 7 o'clock. Yeah, it starts in 1 hour. So for those living in the US, the tax session happening for you guys. There's a tax specialist speaking there as well. So you can ask him.
Yeah. There's another question that said it seems it's generally like a statement. It seems it's generally more tax efficient to exist as a business in the UK.
Yes, UK has a quite a fairly favorable tax regime compared to a lot of other countries, even compared to a lot of EU countries as well. I mean, we in the UK kind of have the view that we're taxed, all over the place, but I can confirm that we're more favored from a tax perspective in the UK compared to a lot of other. There are very, very few European countries out there that have tax regimes that are as favorable as in the UK.
And then there's another question. Does the fact that we normally take claim back tax when giving to charities affect us claiming back?
Yeah, so yes, it does affect you. So if your tax relief on income can only be claimed once. Okay, so you can't claim tax relief on income, on the same income twice. So it's you as the person giving the gift aid or the donation is claiming the tax relief, or you're forfeiting the tax relief and you're allowing the charity to claim that tax relief. So if on your form or your donation form, if you click that the charity should claim the tax relief, then you can't claim tax relief on the same money. I hope that makes sense. So only one person can claim tax relief on that single money or on a single donation.
What tax and accounting services can you render to TCN group members beyond this advisory meeting?
Yeah, I mean, I cover quite a range of tax and accounting services depending on specific individual needs. So I looked after personal taxes, I look after company taxes. So whatever your need is, if you've got a company or you've got a business, I can look after your taxes for you, covering a range of things, your personal taxes, your payroll, your VAT, your corporation tax. If you need guidance on property taxes as well, I look into that as well. I cover that. Yeah, if you feel you need any accounting advice or service, feel free to reach out, and I'm happy to support you guys.
Anybody with any other questions? I don't see any other questions on the group.
Can I just ask a question?
Okay.
Can you hear me?
Yeah, I can hear you, Femi. Go ahead.
Okay. Sorry, it's about pension, but sorry, I'm not sure if it's the right place to ask it, but I'll just ask. You know, you did mention people can reduce the tax to pay by increasing their pension. So for people who, let's say someone, I mean, if you can answer it, that's fine. If you can't, it's all right. If you work for one of the government agencies, you know, let's assume NHS pensions, for example, and then because there's a fixed amount that would go into your pension for that every month, can you voluntarily decide to add to that? Let's say you've got income coming from another source and you just want to push that in there. Is that something does it work that way?
Yes, it does. So you can make voluntary contributions to your pensions and ask your employer to deduct at source. That is something that a lot of people do to reduce their taxes and contribute more towards their pension pot. So yes, absolutely doable. Yeah, feel free to engage your employer, and I'm sure they can. Most employers would arrange that for you.
Okay. The reason why I asked this because I think that automatically means the employer is going to have to contribute more to my pension. Because that's why I thought, will they be willing to do that, or?
No, so I mean, a lot of depending on your contract. Some employers what employers tend to do is have a matching contribution subject to a cap. Okay, so they could say for every X amount you put into your pension pot, we would add Y amount subject to a limit of, say, £100. So what that means is if you were to contribute something more, so you were to contribute an amount to your tax account that would increase their own contribution above that 100, their own cap is that 100, and then that's it. Does that make sense?
Yes, it does. Thank you. Thank you.
Yeah. But yeah, by all means, have a conversation with your HR team. They'll be able to run you through the specifics of their pension clauses. And I mean, I've not come across any scenario where there have been restrictions in people making additional pension contributions towards their pension pots. But the worst case scenario, if you were to have restrictions, the only scenario where I might see that there may be a restriction is maybe if you had one of those really, really old time pension schemes, which are kind of defined benefit schemes. There usually quite a bit of restrictions around those, but companies don't really offer those anymore. For worst case scenario, if there were limitations on how much you can put into your pensions, then you could set up a private pension for yourself and make your contributions that way. The tax effect is still the same, because if you get paid after tax and you take your after tax money and you put into your private pension, the government refunds your tax that were deducted at source on that pension amount anyway, automatically. So you still come back to the same place.
Oh, okay.
So that's a workaround. If there were any restrictions around how much you can put into your pension pot.
Remi, please, I have one last question. Sorry, JJ, I apologize. So I can't remember if it was a session I attended or if I read it somewhere, that if I want to, that another legal way to be tax effective is if I buy a property using my pension pot or something like that. I wasn't too clear. So something about I save the money through my pensions account and then buy a property through my pensions account for investment purposes. And then it's tax effective that way.
Yes. So now for property, now investing in properties through pensions, it's quite technical and it's not very common. So generally, a lot of pension pots do not allow property investments. So mark the word generally, okay? However, there are some specialized pension schemes provided by certain specialized pension providers that allow you to buy commercial properties within a pension, okay? Now, there are two types of pension schemes that do that, to my knowledge. There is the SIP and there's the SAS. The SIP is the self-invested pension plan. The self-invested pension plan, most cases, only allow things like bonds, cash, stocks, and shares. However, I'm aware that there are some specialized pension providers that allow you to buy commercial properties within a SIP, but there are not a lot of them, okay? And there's also the SAS, which is like a pension plan that is put in place by a small business for a small workforce. So it's most commonly used by really small businesses or small limited companies, sole director type limited companies. So SAS, which is also a pension scheme, is slightly more robust and more flexible than a SIP, because with a SAS, you can buy a commercial property into it, okay, and then you can borrow money from the SARS. And so the company that puts the SARS in place can lend money or borrow money from the SARS to do other stuff. So it's more kind of flexible in that way compared to a SIP. But it is still a pension pot, it's still a pension plan as well. Now there's some specialized providers that provide that service. And I have a few clients that use that vehicle for their pensions, SaaS, and they buy commercial properties into that SaaS. And the SaaS kind of generates income, which is either reinvested or used for other purposes. So a SaaS or buying a property into a pension pot is a good thing, or is a good approach. But above all, the key thing is ensuring that you're not just buying any commercial property because you are buying it into a SaaS. You still have to make your underlying investment case and investment decision to say, if I'm buying this property into my SaaS, does the investment case make sense? So you have to kind of assess the investment case of the commercial property before you decide to even put it in a SaaS in the first place. Does that help?
Yes, it does. Thank you. Somebody's asking, what if I use Lisa? First of all, what is Lisa? And then you can answer it.
Use what, sorry?
What if you use a Lisa, L-I-S-A?
So I think that's a lifetime ISA. So a lifetime ISA is one of the schemes that the government has put in place. So effectively, it's like an ISA, a regular ISA, but it has some features that a regular ISA doesn't have. So a LISA, a lifetime ISA, is a kind of a savings pot where you put in money, and whatever amount you put in there, the government tops up 25%. And if I can remember correctly, I think you can only use it for a particular purpose, which is towards a deposit for a property. So if you're looking to buy your own home and you are looking to raise your deposit, then you could open a lifetime ISA, and then you can save your deposits into the lifetime ISA, and the government tops it up with 25%. So it's a quicker way of kind of saving your deposit because you get that automatic 25% boost that the government gives you.
Remi, you did not tell me that one. No. Wait.
Sorry?
I'm going to harass you. Let's wait. But thank you for asking that question. Let's take this back one more step. Listen, you mean, first of all, having a lifetime ISA tax haven, right? And then I also get 25%, and then I can wait. Hold on a minute. I can use it to buy a property. Am I restricted to the kind? Can I do a buy to let, or it has to be a residential property?
It has to be a residential.
So it has to be where I'm going to live. Okay.
Yes.
But Remi, you did not tell me that one. We shall take this offline.
I think Aditola wants to say something.
Yeah, Aditola, please go ahead.
I'm not busting Anu's bubbles, though, but there's a caveat to it. The lifetime ISA, the funds in it is actually going towards your retirement. So the only thing you can do with it is buy a property. If you take anything out of that savings pot, you don't get the 25%. Just to manage your expectations, because you are very excited.
I'm very excited.
I will find you, woman.
Wait. What are you saying? Does that mean that if I take it to buy a property, then I won't get the 25%? Is that what you're saying?
That's the only kind of
thing why
so long as you take the money.
Go ahead, Aditola.
Okay. So long as the only time you can take money from that pot before you retire is to buy a property. Otherwise, the money you are putting in it, you cannot take anything out of it until you retire.
No, that's fine.
The only time, unlike the normal.
Mm-hmm. No, that's fine. So what I just wanted to clarify was, as long as I can be saving my deposit into that account and then use it to buy a property for sure, I will get my 25%.
Yes, you will. Yes.
Okay. Thank you very much. Thank you. That's all I need to know.
Any other questions before we round up?
Yeah, sorry, I'll just ask a question there, just based on the last discussion. Is there a cap on the amount for this one? For the lifetime ISA that you mentioned, because I think I'm aware for the normal Help to Buy ISA, which banks have, I don't know if it's somewhere else, there's a cap on the maximum amount, and you can get 25% on. So just ask him.
I'm not sure of what the cap is. I think I'm with you on that. There probably may be a cap. The regular ISA has a £20,000 a year cap, but I'm not sure of that for ELISA.
Well, somebody just sent me a message and said
4,000 every tax year.
it's limited to 40,000 a tax year. All right.
4,000.
Is that 4,000?
Yes.
Okay.
So 4,000 per tax year.
All of you, thank you for busting my bubble. Let's have a good evening.
So invariably you're saying 4,000 is small. You're a big madam.
I don't understand what you're talking about. 4,000 is not sufficient as deposit for a property.
Okay, everybody. I would just say that I won't be taking any more questions for now. I would probably allow Mr. Oseni give maybe a few closing, things that he needs, tips that he needs us to, hold on to. And then we would please stay back when he leaves for just a quick catch-up meeting.
Thank you very much. So in terms of what we've discussed today, it's mostly kind of general advice territory and general kind of views. With tax, everything is really person specific and scenario or individual specific. I've put my details on the PowerPoint for those who may want to reach out at some point. If you wanted to discuss kind of personal specific scenarios, then by all means, feel free to get in touch. And I hope you found today's session useful at least, and wish you all the best.
Thank you so much, Mr. Oseni, Remi. Before you leave, I just saw somebody just ask the question. So I'll say this is the last question. Please oblige us. This person says, can a US resident buy a property in the UK, and what's the tax implications?
Yes, a US resident can buy a property in the UK. However, one thing to watch out for is there's something that's called tax residency. So there's certain conditions that determine where you're seen as tax resident. So if you're seen as tax resident in the UK, then you pay UK taxes on your global income, irrespective of whatever the source of income is. If you're deemed as tax resident in the US, then you're taxed in the US on your global income, irrespective of where the income comes from. Now, if you're a US citizen, however, and you buy a property in the UK, even though you are a resident in the US, there's a UK law that says, irrespective of your tax residency, once you buy a property in the UK, the profit or the proceeds from the property gets taxed in the UK. Okay, so UK tax applies. Now, however, to qualify that, there is a double tax treaty between UK and the US. So what would then happen is, if you're filing your taxes in the US, and you declare the UK property income. As part of that declaration, because of the tax treaty, the double tax treaty, you'll be able to tell them to say, okay, I have this property in the UK, I've paid this much taxes already in the UK. And therefore, that means that if the US is looking to tax that same income, potentially they would only tax you if the tax you were meant to pay in the US on that income is higher than what you've already paid in the UK. And therefore, in that scenario, you pay only the difference. But if your taxes in the US is lower than what you've already paid in the UK, then you're unlikely to pay any further taxes in the US. Now, that is the general double tax treaty rule. However, it is important to look at the double tax treaty between the UK and the US specifically, to look at the specific clauses around property income. Because sometimes there may be a general rule, but there may be some other sub-clauses that need to be taken into consideration to really drill down into the actual tax effect. But generally, though, the case is usually that if you've paid tax on the UK property in the UK, then if you're domiciled for taxes elsewhere, you would only pay taxes there if the tax you're meant to pay there is higher than what you've already paid in the UK, in which case you pay the difference between what you were taxed in the US versus what you've paid in the UK. I hope that makes sense.
Yeah, thank you so much.
All right. So on behalf of the TCN Finance UK Group, we would like to say thank you very much, Mr. Remi Oseni, for your time here with us today. We really do appreciate you, and we pray that God will continually bless you and increase you.
Amen.
And may He grant you your own heart's desires, and you will grow from grace to grace in Jesus' name.
Amen.
Thank you so much.
Please.
His details are on the group chat. I'll not posted it, so his phone number, email address, and how you can reach him. So he's available. Anybody can reach out to him. If you have more questions, if you need him to help you with your taxes, or you need him to, guide you or give you advice as regards that.
Thank you. All right, guys.
Let me say thank you so much personally. I know that I'm always harassing you, but seriously, from the depth of my heart, I appreciate your time. I don't take it for granted. So thank you so much for coming to answer all of our questions and being so patient to answer all of the questions. I appreciate it a lot. But I will continue to
thank you.
I understand that. So
all right, catch you guys later.
All right, thank you, Remi.
Bye.
Thank you so much.
Please, you guys don't leave just for like 15, 20 minutes. Thank you so much for everybody that has been able to, stay back and attend this meeting. Because we have another meeting very soon. I kind of have several meetings today. I just wanted us, we haven't met
Sorry, before you continue, you might want to stop recording because this is going on.
Oh, yes, thanks. That's true. Thank you for reminding me. I've forgotten.